Okay,
Perfect.
it's
All
recording.
right. We
Mhm.
are back in business. All right, let's do this. Okay, so why have I gathered all of you here today besides watching me struggle with tech? It's because throughout my career, which has spanned nearly 2 decades in finance and tech, I have seen women build significantly less wealth than men. I graduated business school back in the day at Chicago Booth with a CFA and a CPA in addition to my MBA. Many of my female classmates were the same, if not more qualified than the men that they graduated with. And yet, a decade out, we often find that men have significantly more wealth. They're in a different league. It's as if they have a roadmap that we don't. And during my career in finance, I saw exactly how this played out, right? I worked with JP Morgan, where we deployed nearly $6 billion into private market funds run by men, invested by men, and advised by men. At Credit Suisse, I was a banker. I sold dozens of e-commerce startups to Fortune 50 retailers. I saw cap table after cap table advised by men. At my first startup, ostensibly democratizing, they offered access to everyone to invest into pre-IPO stock through private funds. We had generated over $4 billion in wealth across 600 investors. I took them from Series B to IPO with a grand total of 2 investors who were female. At my second startup, a democratizing hedge fund of funds, same deal, 200 investors, 3 women. And I finally got really, really sick of it and founded 32 Cents because I said, there is a roadmap. I have amassed a certain skill set over the course of my 2 decades, and I would love to use it to give everyone, to give women especially, and in fact, I only care about women really, to give them a roadmap on how to build generational wealth. So I set out a survey actually before starting this talk, and many of you filled it out. So thank you so much for those who did. What we're seeing is, I just want to give you a couple of metrics from that survey so we can level set the room a little bit and see sort of where we're all starting, right? So the average net worth of women in this room is around $2.5 to $3 million. Our average portfolio, investable portfolio, is around $750,000 to $1 million. The most commonly invested in assets are startups, real estate, and strangely collectibles. I ran the survey 5 years ago and it wasn't collectibles. That wasn't there. So that's a new asset class, which is really interesting. Less than 10% of us, though, have invested in private equity, hedge funds, pre-IPO stocks, private credit, and venture capital, which are the backbone of private market assets. I also gave everyone a series of statements that they could that they would agree to if they had familiarity with them. Like, do you know what donor advised funds are? Do you know how to invest in search funds? Do you know how to put together club deals? Do you know how to use your IRA to make investments, et cetera, et cetera? And I gave you these statements because these to me are the language and the tools of building wealth. And yet only about 1 or 2 people in the people who took the survey really were familiar with this language. So that's, again, unfamiliarity with the language of investing is one of the reasons I think that we often struggle to build generational wealth. I'm going to assume the following things with this room here today. I'm going to assume that you've saved a fair amount of money, enough that you can sleep at night, right? That you own your house. If you don't live in SF, LA, or New York, like that you own your house, or that you could, because it's insane. I'm going to assume that your retirement is pretty well funded, that you have a decent public market portfolio, that you have an advisor that you like, or at least are getting along with, that you're saving comfortably for your kids' education, that you've built some wealth through equity in your employer, and that you have a household income of around $300,000 or could have that, right? So that's what I'm going to assume. So I would love to hear from everyone. Just give me a thumbs up if you resonate with most of that, if not all of that. Awesome. I'm looking down, I'm seeing a fair few thumbs. So I'm going to assume that is largely true, which is fantastic. So what's next, right? We can take a page out of how elite allocators, like the Harvard endowment that grows at multiple teen-digit percentages per year, or the family offices of hundreds of millions of dollars, they think about their money. They think about their portfolio like building a commercial aircraft, right? It is safety, efficiency, and speed. By safety, I mean rigorous portfolio level risk management, capital preservation, right? So their aim is not to eat into their capital nearly at all. Then they have efficiency, which is tax optimization, fee optimization, et cetera, because over time, as the power of compounding, taxes can really drag upon your returns. So one of the things that we're talking about today is tax optimization. And then there's speed, growth, and upside. These elite allocators often have 40 to 50% allocation to private market assets, which is diversified and systematic. They also use their wealth to invest aligned with their mission, vision, and values. That is to say, they use their wealth to drive change. They use their wealth to build their brand. They use their wealth as a tool to have impact in the world. We can tweak all of these, but follow the same playbook to really help us maximize our investment. And Deepti, I hear you asked a question about pre-IPO and startups. Just to quickly answer that, pre-IPO would be Series D plus traditionally. So a year or two away from IPO, whereas when I say startups, I mean pre-seed, seed, Series A through B or C. That's the general definition. Many investors may have their own kind of where they draw that line, but in my world, when we ran Forge Global, that's where we drew that line.
Thank you.
Of course. And by the way, feel free to interrupt, feel free to jump in. This is not a long slide deck, so we'll have plenty of time for that back and forth as well. So the immediate next step for us, assuming this level setting exercise is true, is to invest into private markets. What do I mean by private markets? I mean private markets through funds, hedge funds, venture capital funds, private equity, real estate funds, real assets funds, that is collectibles, art, wine, etc. funds, pre-IPO stock, and private credit. You can also invest directly into startups or real estate or Main Street financing. These are all private market assets. And why do we want them? Why do I say that they are our next step? First of all, they can add pretty massive upside to your portfolio. Average private equity returns in the top quartile over the last 20 years are around 20 to 25%. Average top quartile hedge fund returns are in the 30 to 40% range. Over time, this can lead to significant wealth when compounded. They also balance out your public market portfolio because they're what we call uncorrelated with the broader stock market. When the market moves one way, they don't necessarily move in the exact same way, so that you will have steady returns over time. Also, your dollars can have an immediate impact, right? If you invest in a founder, they get impact right away. If you invest into a fund, you as an LP have way more agency into what that fund does necessarily than if you buy a share of, say, Microsoft. It can also have an impact upon your career if you leverage that investment well. But, big but, they require a steep learning curve. They are significantly riskier than public market assets, with less information available overall. The information that you do find is often opaque. It's hard to parse. They write these prospectuses in a way that makes them deliberately hard to read. I think they could do a lot better at it. Building a good portfolio of these assets is complicated because they move against each other, sometimes in not intuitive ways. It's also quite expensive. The average top quartile hedge fund has a minimum investment size of between $2 and $5 million. One of the PE funds that 32 Cents is investing in actually has a minimum investment size of $10 million. So if you want to put together a portfolio with all of these different asset classes, the ventures, the hedge, the private equity, real estate, etc., we're talking, you need millions of dollars to do it well, which makes it really hard to access. But this is such a important asset class, and it is literally the next step that you need to take when you have your public markets in order, which is why I founded 32 Cents, right? 32 Cents is a diversified fund of funds, meaning we invest into several private market funds for a minimum investment amount of $10,000. I saw that there was really no way for women or anyone else really to break into this private market world affordably, and that's why I started this company. There's also education. So you become a sophisticated LP by having a seat at the table. You learn with the community. And so joining us is a great way to get started, getting your base, a good base level of diversified private market assets in your portfolio. What we're good for is that foundation. What we're not good for is direct investing into startups. That's what I want to highlight. I want to highlight Bridget, who's here with us today as well. She started a fantastic angel group, which I absolutely love. And that is a great way to get invested directly into startups as an investor. And so this actually has to move side by side, is you join 32 Cents and then you join Bridget's group and then you get that sort of diversified access into funds and directs. And that's how I would very pragmatically get started, because you'll see these presentations many times that are like, oh, do this and do that. And there's not really like a, what do I do next right now? This is what you do next right now, if you like. So moving forward, right, we talked about what's next. We talked about private market assets. We also let's talk about taxes. First of all, I'm not a tax advisor. There's no tax advice. However, you know how those ads when they say, talk to your doctor about Wellbutrin. Well, talk to your advisor about tax advantaged funds, because they are a fantastic way to shield capital gains as well as make a good return. And they're also high impact because they invest into economically disadvantaged zones. So these are called opportunity funds. I work with them at JP Morgan. They're actually a thing. Every major bank will offer one. So it's a good thing to start to explore with your advisor and to say, is that right for me, right? And then there's, once you're done with that, there's also generational planning, right? Which is charitable remainder trusts, which basically get you to generate income over the course of the trust. And then at the end of your life, the remaining assets go to charity, which is a great like automatic allocation tool. Trusts generally are a powerful tool. And again, I would ask you your advisor about them. If you're going to donate funds for charity, I would consider donor advised funds. Again, if you want me to elaborate on any of these, pop in a question, raise your hand, I will answer. But basically, donor advised funds are my favorite tool in your arsenal because they let you park assets, take the charitable deduction, and then allocate the assets over time whenever you feel like you are able to go do so. So again, and when I say ask your advisor, I'm going to take a quick pause here and say, your advisor should make you feel heard. Your advisor should answer all your questions. Your advisor should make you feel like you're learning something. They should never make you feel like you are not understanding or feel slow. If your advisor doesn't do all of these things, then find a new advisor. Like they have to help you get beyond that. And again, it's a dialogue. But if you go to them and say, I want to invest in this asset, they should be able to answer exactly why or why not that makes sense for you. Again, this is pretty much a crash course, but I'm here to be a resource to anyone who wants it as well on where to go next.
Zara, one quick question.
Yes.
Hi, this is Zara.
Yes,
So, I would just say you're assuming here that everyone has an advisor. Some of us may be investing ourselves. We don't use advisors. I've used advisors in the past. I like to keep control in my own hands, and I do my own research and whether it's intuitive perspective, being in the industry for long enough. So my take is this: if I'm, making these bold moves myself, probably I should, discuss those with my tax accountant because I'm doing all the research myself.
absolutely.
I'm asking, correct?
Absolutely. Yes, you
Okay,
should.
thank you.
Yes, as you should. And by the way, if you want someone to chat with on a sort of on the, I would say, financial advice 2.0 to like help you with your research, let me know. I have a fantastic person, and she's really good at keeping a pulse on the modern tools available, because some advisors, they are often like, they might not know what's happening in the last 5 years, last 2 years. The markets move very quickly. So
Yes.
yeah,
And that's exactly why I was bringing up, because some advisors are very old school. I don't want to bracket them, but they are, as a result, they are risk averse. And there is a time frame in your life where you can take risk,
yes,
despite how the market is and so forth. And you don't want to be basically giving the control to someone who's very risk averse.
that's a fantastic point. And I think there is, look, advisors are really good at certain things, right? The reality is, and I guess the dirty secret really is, that most public market diversified portfolios look and behave about the same. Like, they're not BlackRock versus Vanguard versus something else is going to behave roughly similarly. And, constructing a good diversified public markets portfolio for you that does all the right things and tracks indexes broadly with good sector exposures, they're trained to do that very well. So that's one thing that they're good at, right? Generational planning, they're often pretty good at that, right? Um, exactly. And they're great at wealth preservation, right? But look, I studied for my CFA, right? 5% of the curriculum when I studied was devoted to alternative assets. All of this presentation was 5% of a 3-year course of study. And that's how advisors are trained. And that's how they practice. And so going to the next level, something that you have to start the conversation around. And if you don't use one, that's great as well. Taxes, again, are something that you do need to consult with tax accountant for. But once you're done with that, right, and you have the advice, again, to disseminate advice like this or tools like this, or tell you about the options, or again, why I started 32 cents, not to keep doing this, but there was a market gap that I saw and said that private markets and other kind of higher level tools are just not being talked about or being given to women especially. And it's often worse because we don't talk about money amongst ourselves. Like, not often anyway. I mean, that's changing now very slowly, but it's often with my girlfriends, right? And I'm in finance, we barely talk about money. But men will talk about money in a second, and so they're just more familiar with the language and the concepts, and they tell each other, and so the roadmap becomes clear. Whereas for us, we may need to be a bit more intentional about it, and that intentionality is where 32 cents comes in. Siksha, that's exactly what I was saying, right? So to access these, there are okay, let's go from top to bottom, right? If you have 10 to 50 million dollars, right, you can get access to fund of funds by various big banks like Goldman, JP Morgan, Morgan Stanley, etc. will have them, right? And that's when you get access to a fund of funds at that level. If you're in the kind of the 1 to 10 million range of assets, which all of us here are, there really isn't a good way for you to get access to them. 32 cents, which I started, is a fund of funds to give you access to all these assets. I didn't see anything in the market for that. What you have are single products, like you have pre-IPO has Equity, Zen, and Forge. You have for fund of funds, for hedge funds, you have Equity. For private equity, you have Moonfair. These have a minimum investment size of around $250,000 to $300,000, and that's how you can get access to some of those assets. Angel groups or venture investing groups like the one Bridget runs or the one the Chief has, etc., they give you access to venture capital funds. They give you access to direct investments in startups. You can access some deal flow that way as well. But to get a diversified private market access fund of funds, I think 32 cents, unfortunately or fortunately, is one of the things out there that I would recommend that you start with. You can always go deeper. And what will happen is once you get through investing with us, all of these 7 asset classes, you'll kind of get familiar enough to say, I like middle market private equity buyout funds. So how can I get access to those? And you'll start to network and have these conversations and then begin to like slowly attract that kind of deal flow towards you. Right? But having a good base, I think, is the first step. If you want a good advisor, I can recommend you one. Asiksha, please ping me. I will recommend you one. I recommend her to everyone. She's fantastic. Okay. Once we've talked taxes, let's talk impact, right? As a private market investor, you can actually hold funds accountable because LPs hold the strings to capital. If you attend the meetings, if you pay attention to what they're allocating into, if you offer advisorships, if you ask for board positions, if you amplify and connect founders, if you bring them deal flow, right? The founders that you know, you can basically start to have a real impact on how capital gets allocated. And again, sorry, Bridget, to like call you out again, but you had a fantastic, remark in one of our deal presentation meetings at 32 cents when you called out Moonfair and said, hey, where are any of the people of color or the women in your portfolio companies? That's the kind of question that we as a powerful LP get to ask. And we as any LP get to ask those kinds of questions. And that's something that can be really powerful if you use it right. And again, 32 cents, brings us all together. And so we invest together and we amplify our voice. But as an impact perspective, private markets can help you have a direct impact as well.
So, Clara, a quick question. When the question was asked, what was the answer?
The answer was, how can we work with you to make it better? Right? Often the answer is, we don't really have anything right now, and we're trying, and private equity is literally a field full of white men, but how can we work with you, 32 cents, to make it better? And so that's something that we're working on, so you can drive change from multiple perspectives. I think asking the question is a fantastic start. I think working with them to like drive actual change for it. For example, with Moonfair, right? They have an initiative called Women in Private Equity. We are working with them to create an investable universe of female private equity emerging fund managers that will attract institutional capital. That's one of the ways that we can drive change. It's not always there, but we can make it happen. I always end presentations like this because I think this needs to be told. Find your allies and trust your instincts, because you know more than you think. You are astute and you are wise and your questions are valid. And we can make a lot of change by just talking to our friends, to our colleagues, to our acquaintances, to strangers. That's how I got started, right? Like I had a lot of conversations in addition to my background in finance, and that's how I got to know how to do all of this effectively. So that's all I had. What can I answer for you? Like, what can I go into in more detail? How can I help?
So another question I would have, this is Zara again, in terms of your uh, so if I use, let's say, Charles Schwab,
Yeah,
I use their portal. Would you be connected to some of these portals and I pick your view, or would I need to use your portal to pick the right investments
you would need to
types?
use mine because Schwab doesn't offer this yet. And I haven't connected up with them yet. So we are a club of people who invest together into a fund of funds. So you will need to use me to get some of these deals. Eventually,
But
I will 100% want to integrate with them, but not yet.
okay, and what about how long have you been out in the market?
We've been out in the market since January of this year, but I've kind of been informally running clubs like this for the past 5 years.
No, so that is cool. But the reason I'm asking for, how long have you been in the market is from the portal standpoint,
Yeah.
technology standpoint, safety protocols, and security standpoint. What's been your experience? Are you, constantly making updates? What kind of, technologies do you use, and how are they backed and supported?
Yeah. Right now, honestly, we are defaulting. So we're not building ourselves like a tech company with a huge portal because there are vulnerabilities there that we're not capable of like handling quite yet. So we're doing everything at this stage the old-fashioned way. So we have access to these funds, we put them into a fund of funds, I do the allocation, I do the balancing and the critical differentiator there is that I have a CIO, Susan Stone, who's on this call as well, who is been an allocator for 15 years. And she and I bring investment decisions to the members of 32 Cents and we invest together. And so you learn about these assets while investing in them. And frankly, it's secure because it's done the old-fashioned way.
And also, Clara, you have two questions that are similar in the chat from
the
yep.
10K is deployed immediately. So it's a share of a fund of funds, and you have the 10K have access to all the underlying funds at the same time. So it's one share of a fund of funds. The fees are actually 0-0. I charge no fees on the assets under management. I charge a fee for the community and the education of $1,000 a year. That's flat, depending on how much you invest. But that is basically the only fee that I charge. The autonomy, so as a club member, you will actively take part in the decision-making of the whole portfolio. That's the beauty of what we do, in that you're able to say, I will say to you, this month we're going to be allocating to hedge funds. And then you will get access to a choice of 3 hedge funds, right? And then you kind of pick one of them for the club to invest into. And that's how we construct the portfolio. And I inform the overall allocation and the balancing aspect of things, but you get access to funds like Genstar, funds like CVC, funds like, Equi, etc. When choosing financial advisor providing more than, so if you choose, so this comes down to the difference between, and so I'm answering Vicky's question right now. This comes down to a difference between RIAs who manage your money and will charge you by a % of AUM, or just advisors who may charge you just for a flat fee for the advice. Right? So it just depends on how comprehensive you want management to be. If it's allocating your capital, it's usually a percentage of AUM. And Manjit, yes, the minimum investment is 10K per year for 3 years.
And Clara, do you want to also say that one of the goals to invest is with female money managers?
Yes. Yeah. So our investment policy statement is out there for the world. Like, we invest into female fund managers wherever possible. We obviously will be looking for returns and the best performing funds above all. But that's basically how we're weaving diversity in right directly into our investment criteria. So the way to think about the investment, Siksha, is to look at the underlying funds that we are investing into. For example, we invested into a private equity fund this month called Moonfair, and that private equity fund has a historical return of around 14%. And so that's how I would look at that contribution to the overall portfolio. Part of the work that I do on top of the fund itself is to manage the overall portfolio risk and to allocate it appropriately.
And do you want to have Susan talk a little bit about how she sources the deals?
Yes, I would love that.
A quick follow-up question, Clara, on Moonfair. When I saw the email come through that we've invested, I was really excited. Being an investor in the club, 32 cents. My question, I just want to ask a really quick follow-up question before you switch gears. So, so I made my initial investment, but now I would like to invest more. So can you just share that approach for the folks on the call if they choose to maybe come in at the minimum of 10, but then later when they see, you know, the traction and they see the kinds of deals that we're closing, like me, they may want to come in at a higher amount. You know, they may want to add to that. So can you just kind of address that while you're talking about Moonfair?
Yeah, absolutely. So you could add in more fund at any time and at whatever cadence you like. We do closes every month. Basically, the way the structure is called an evergreen fund, right? So we constantly take in capital and we constantly deploy capital. So this month we are fully subscribed for Moonfair, and then we kind of keep taking in more capital month by month by month, and then we keep adding asset classes, and then we'll keep rebalancing the portfolio accordingly. And again, not to sort of belabor the point about 32 cents, but it's one of those things where if we take a look at, like, you know, how the question really is, you know, how do you access these kinds of investments? And the reason I started this is because of that. And again, I don't want this to go off as a sales call. That's not my intention here. But next steps wise, private market assets, you know, tax optimization, having an impact, charitable donations, all of these kind of come in sequence. And one of the nicer ways to get into private markets for a 10K minimum is through my fund, and that's why I'm talking about it here, if that makes sense.
Clara, would you also say, I mean, the only other way to source private investments really would be through a family office, a private bank, but you need to be really high net worth. So this is really
basically one of the things that we've been able to do, because we're doing it collectively, and the power of collective bargaining and unionization, right, is to be able to demand lower minimums. Moonfair's minimum, they brought it down by about 30% for us, because we asked, and we were like, you have no female LPs. We have 40 women who want to invest in you. What can you do for us? And they're like, yeah, what can we do for you? So that kind of helps. Also, as a woman in this space, you have a lot more power as well. Like, I mean, if you want to get into a fund and they say the minimum investment is $100,000, just ask them, can I put in 50? Can I put in 20? Right? And they may say no, but they may say yes. And, you know, often we're not taught to ask the question, can I put in less money? Ask. They may let you in. It just takes a lot. It takes a lot of networking and sourcing. So a lot of what Susan and I do is we have access to private data sources. We crawl through all the data. We figure out which funds work for us. We figure out which funds make sense, and so on and so forth. So, and you can do it on your own. It just gets a little tricky if you want to, like, if you are trying to work with minimums, anything with a portfolio of less than 10 million, it can get tricky. That's what I will say.
A quick question. I apologize. I can't use the functionality on Zoom to raise my hand. Hi, Clara. This is Chloe. So I have a quick question about the $10,000 minimum. So is the 10K minimum, is that in addition to whatever membership fee we pay to access this network? Or is that a minimum that goes straight into the amount that would be invested and we're welcome to invest more than 10K?
That's exactly it. So the 10K gets completely invested. The annual fee is $1,000 a year, but that's just for the community and the education and all the other things that I provide and the access. Right? If you invest 10K or 100K, it's still going to be $1,000 a year, and the full 10K gets invested. I charge 0 fees on that over time.
Got it. And then my follow-up is, are you providing any sort of like portfolio summary for us? I know there's a question about platform earlier, but let's say, I'm invested over a number of years and I want to know, what is my spread? Where am I invested? How am I doing? What's working? What's not working? Is there a way that you can help us summarize this across the different investments?
I will do you one better. We are built on the principle of radical transparency. So every email that I receive upwards will be visible to all the members in case they want to access it. Every piece of diligence that I look at will be accessible. If you're a member, you can be on every management call with me. Every quarter, we will do a summary of the portfolio and the actual valuation of the portfolio and exactly what it's worth. Every year, you will get a tax document, but even in the interim, right? Any information that I get, if I hear, oh, this fund is exiting, or oh, this company has, a bad year, I will know, and I will let you know immediately, because again, to me, it's all about, I founded this to make everyone great investors, great LPs, investing into all manner of things. I don't even want all of your assets. Like, I would rather you give me half and put the other half everywhere else once you've learned all about how to be a great investor. So anything I can do to further that, including giving you full transparency, full accounting, full knowledge, I will do.
Great. Thank you so much.
Absolutely.
Hey, Clara, it might be a little soon to mention this because you and I haven't had our collaboration call yet, but on the startup investor side of the house, which Clara graciously mentioned during her presentation, and I thank you for that. So the angel group that I'm launching, and we go live in a few weeks now, there is a dashboard that is part of the benefit of being an angel in my group, and that dashboard does cover the question that was asked, I think, by Chloe. And I would love when you and I, Clara, get together, Clara, is to talk through how we can somehow marry the private, the alternative asset portfolio to the startup portfolio, and then bring those two together.
I would love that. That would be fantastic. I would love that.
Hi, Clara, I had a question on the rebalancing that you mentioned of the portfolio. So how would that work? Like, for example, we made initial investment for 10,000, and let's say it was all put in the fund that you just mentioned. I forget the name of the fund, the morning fund or whatever you mentioned. And then you would, So when you rebalance it, would you take funds out from there and rebalance it to another fund, or how does that rebalancing happen?
This month, let's say that we took in $100,000 because we let in 10 members, right? Next month, we'll have another $300,000 because we let in 30. And then those 30 members, that $300,000 we can use to make additional investments that will balance out Moonfair. So we don't take it out, but we add on. We rebalance by adding on.
Got it. So, but it would all be in Moonfair itself, but it gets, you would just keep adding on to, in the additional investments also keep going into the same fund, into Moonfair fund.
No. So as a Moonfair is the private equity allocation, there's a hedge fund allocation, there is a venture capital allocation, there's a real estate allocation. So there's all of these different asset classes kind of working in concert. And so whenever one of them begins to rise, or I have too much exposure into one, I will just buy more of the others to like even them all out to what the net allocations should be. Does that
Oh,
make sense?
got it. So
Yeah.
you'll rebalance within Moonfair itself, you'll rebalance the allocation of the
Exactly.
investment. Right.
Exactly.
Okay, thank you.
Cool. Well, I'm here for any other questions. I'm here for any other advice. Like, at some level, there's many things to get done after we kind of start at this level. And I think it's one of those things where, as growing up, I was literally given 3 pieces of advice. I was given the advice of save money, get a good job, save money, buy a house, right? These were the 3 things I was told by my father, who meant really well, but that was basically the 3 things I was told. And then I had to basically build everything up after that. And I want to make things easier for others coming after me. So I will, send this presentation around. I will follow up with every one of you in case you have other questions. I would love to hear from you as well. In case you have any other thoughts or comments, let me know. And otherwise we can give some time back. Hopefully this was useful.
This has been excellent.
Okay.
This has been excellent.
Yeah, very useful, very informative. And for me, I'm just processing the information, so I will certainly follow up with additional questions, but I do appreciate you leading this type of forum because you are absolutely correct. As women, we do not talk about money enough, and we should.
Amazing. Well, thank you very much again. Have a fantastic rest of your week.
Thank you.
Bye.
Thank you.
Take care.